Good evening, everyone, and welcome to our third webinar sponsored by Highway Media Group. Like always, drusu here. Tonight, we will cover some charting techniques and how to use them in different situations. I hope you won't get bored fast since this is a more technical presentation. And with no further ado, let's get started. Now, one of the most important tools used while trading Forex are the different Forex charts. Usually traders use these various kind of Forex charts to look for any patterns in historical price action so as to forecast a potential move in the future. Now, our prime focus is to go beyond terminology and wrap our heads around how and when to use them. I will take your questions at the end of the webinar if times allow it. If not, you know what to do. Please address them by email. So, first in our list, it's line charts. Now, the line charts in Forex are designed to connect a single price for a specific period of time. Uh, Among the most popular of line Forex charts is the daily chart. The majority of Forex traders pay attention to the closing price, which, by the way, they recognize as the most important. But one of the drawbacks of line charts is that they make it very difficult to see the price activity for the balance of the period. It is also not easy to follow the gaps and breakups in prices at joints of trade periods. In spite of such issues, the line Forex charts are easy to follow and simply to use. We will have a better look on our MT4 later on after we finish with the explanation on what charts are. So you will understand when you can use it, if it's better to use this type of chart when you draw your resistance support, but we're going to get later on that. Second are the bar charts. Among other kind of Forex charts are the bar charts. Now those have rectangular bars with lengths comparative to the values that they are indicating. These bar Forex charts are very useful in comparing two or more values that are taken over different time or different conditions, usually on small data sets. The bars can also be horizontal and have the benefit of displaying the currency range for the selected time period. The advantage of using bar charts is that they are able to plot price gaps, and we will have a look at it later on our MT4. And of course, the third charting technique, candlesticks, which everybody loves and prefer to use. Now, they offer a unique method of charting which is applied by traders and investors to all kinds of markets like stocks, options, futures, or Forex. One glance at this Forex chart, it's enough to gauge the mood of the market, whether it's bullish or bearish. Closely related to the bar chart, the candlesticks consist of four major prices, like highs and lows, open and close. Over the years, traders and brokers built patterns based on how candlesticks were formed. But a little bit of history, candlesticks charting dates back into the 16th century. They were actually developed by Japanese traders in 1600s to trade rice contracts. Now the techniques obviously evolved over the time into the candlesticks charts used today in Japan and the countless other technical traders all over the world. The starting of Forex candlesticks, though, it's seen in a military environment which persisted still in Japan. Now, before moving forward, I would like to show you a slide with different candlesticks formations used by professional technical traders. It may look confusing and overwhelming, but remember that no one was born with this knowledge, and even the best traders in the world started like yourselves from basics. Now, depending on the market's movement, if it's a bullish candlestick pattern, if it's a neutral or basic, bearish candlestick patterns, you can see and identify different formations. In future webinars, we will go over every single one of them and explain you how they are formed and how the trends are changing when you see such formations. Nonetheless, if you want to learn more, I recommend visiting Baby Pips for basics on how to trade. And if you prefer a one-on-one session to speed up the learning process, consider signing up with one of the brokers I mentioned in our previous webinar. Every broker is different, and depending on your trading needs, you can choose accordingly. If you're a beginner, I suggest starting with UFX, eToro, 24 options, or EverFX. Now, all of them provide its clients with a massive knowledge database, video on demands, trading signals, social trading, and many other trading tools.
The most important aspect of trading is time charts, because by using a different time chart you will be able to build a strategy that is meant for a short time period or a long time period. Now, time frames in forex charts depends on the density of the data. The lesser the compression and density of the data is, the more the details display on the chart. Depending on the time period in forex chart, you will be able to pick from intraday, daily, weekly, monthly, quarterly, or annual data. The daily data, though, comprised of intraday data that has been compressed for illustrating each day as a single data point or time period in forex chart. The weekly data consists of daily data compressed to show each week as a single forex chart time frame. The more the compression of the data, the longer is the time frame possible to display the data. Maybe I created a little bit of confusion, but let's make it as simple as possible. If you see the slide in front of us, you will be able to identify from the top left to the bottom right, we have different time periods. We have a 1 hour, we have a 4 hour, we have a daily, and we have a weekly time chart. It's on the same currency pair, Euro USD, and as you will be able to notice, different strategies can be applied on depending on the time frame. Now, one thing to remember, and like I mentioned in our previous webinar, is that depending on the time frame you are looking at, each candlestick represents that specific time frame. So if we are looking at 1 minute, we understand that every candlestick represents a 1 minute. If we move to a 5-minute time chart, every candlestick it's 5 minutes, which means that 5 candlesticks of 1 minute are compressed into one of 5 minutes, and you can do the math for the different time periods. Usually there are 20 trading days in a month and around 252 trading days in a year. One can choose the time frames in forex charts and the data compression depending on the trading or investment style. So if you are more of a intraday, that means you want to get in and get out fast. If you are an experienced trader and an investor that knows how to build long-term strategies, you can build your strategies on 1 day time chart, so on and so forth. So traders interested in short-term price movement usually focus on charts made up of daily and intraday data. As you can see on the top of the slide, we have Euro USD on 30-minute, 1 hour, and 4-hour time chart. Shorter the time frame in forex charts means less dense data, which is easy to read and with more details. But these short forex chart time frames can be volatile, containing lots of noise. Sudden price movements with wide high-low ranges and price gap can affect the overall picture in these charts, and it can become confusing for the trader. weekly and monthly time period, as you can see on the bottom one on US Tech or Nasdaq, is the focus of investors to mark long-term trends and forecast long-term price movement. These long-term charts are typically 1 of 4 years in time, and it can cover a longer time frame. The compressed data doesn't project the price movement as extreme, and that it's often less noise. Let's talk about now support and resistance. The concept is quite simple. There are two of the most discussed attributes of technical analysis. Now, this part consists of analyzing chart patterns. These terms are used by traders to refer to price levels on charts that tend to act as barriers. As you can see in this slide, it's preventing the prices going in a certain direction. At first, the explanation and idea behind identifying these levels seems easy, but as you will find out, support and resistance can come in various forms, and the concept is more difficult to master than it first appears. Since we identify time frames, for every time frame the support and resistance may change, and as you will see later on our explanation on a demo account, hopefully it will make much more sense. Now let's try and define support and resistance. We're gonna start off with our support, which is the price level where a downtrend can be expected to pause. Okay, it is because of an increasing concentration of demand. If you are able to use the stochastic oscillator, which I showed you how to calibrate and use in our previous webinar, you will be able to understand why the support acts like it is, because usually what happens is the demand will, obviously the price will go low, and once the demand is increasing on the stochastic, you're going to see that cross below the line of 20, which act as our support now, and it will rebound. Now, as the price of a security or whatever asset you are trading on drops, demand for the shares increase, thus forming the support line. Meanwhile, resistance zones rise to a sell-off when prices increase. As you can see in our resistance line, the same way it can be applied by identifying the highest point where the price started to sell off. Similarly, you can use stochastic oscillator to follow this move and make a confirmation if your resistance and support line are placed accordingly. So once we establish resistance and support, the area between those two lines will provide us a valuable potential trade entry or exit points. And this is because as prices reach a point of support or resistance, it will do one of the two things: bounce back away from the support or resistance level, or violate the price level and continue in its direction until it hits the next support or resistance level. Most forms of trades are based on the belief that support and resistance zone will not be broken, whether prices it's held by the support or the resistance level, it breaks through. Traders can bet or trade on the direction and quickly determine if they are correct. Now, if the price moves in the wrong direction, the position can be closed at a small loss. If the price is moving in the right direction, however, the move may be substantial or not. It depends on the asset and the trade actually. I will explain and I will show you on our demo platform how you can also draw your multiple resistance and support by using Fibonacci retracement. Experienced traders usually tell stories about how certain price level tend to prevent traders from pushing the price of an underlying asset in a certain direction. For example, let's assume that trader X was holding a position in a stock between March and November and that he was expecting the value of the shares to increase. Let's imagine that trader X noticed that the price failed to get above, let's say, $39 several times over in several months, even though it has gotten very close to moving about that level. In this case, traders would call the price level near $39 a level of resistance. So as you can see from our example here, if the prices are climbing and they hit something that we call ceiling, is because the price levels are preventing the market from moving upwards. Now, on the other side of the coin, we have price levels that are known as support, and this terminology refers to prices on a chart that tend to act as a floor by preventing the price of the asset for being pushed downwards. So as you can see from this chart, the ability to identify a level of support can also coincide with a good buying opportunity, because it's generally the area where markets participants see good value and they start to push prices higher again. Moving along to trade lines. Now, this static barrier it's one of the most popular forms of support and resistance. But the price of financial assets generally trend upwards or downwards, so it's not uncommon to see these price barriers change over time. This is why understanding the concepts of trending and trend lines it's important when learning about support and resistance. So when the markets are trading to the upside, the resistance levels are formed as the price action shown and starts to pull back towards the trend line. This usually occurs as a result of profit taking or near-term uncertainty of a particular issue or a sector. Now, this results price action undergoes a plateau effect or a slight drop-off in stock price, creating a short-term top. Many traders will pay very close attention to the price of a security as it falls downwards to the border of support, and because historically this has been an area that has prevented the price of the asset from moving substantially lower. Now, on the other hand, when the market is trending to the downside, traders will watch for a series of declining peaks and will attempt to connect these peaks together with a trend line. As we can see in this slide over here, we define this as an uptrend. It's because we have always newer highs and higher highs and higher lows. The support and resistance, you can see the support is the bottom one and the resistance is the top one. What usually happens here, if a trade reversal will happen, every candlestick that is forming downwards from our support, in our case on this asset, it will start to move lower and lower. So every candlestick needs to create a newer low in order for a downtrend to occur. This may take maybe 5 candlesticks if we are on 4 hours, or 1 hour, or even 1 day. This may take even weeks or months. I'm pretty sure once we get to the platform, everything will start to connect and it will make much more sense.
Now, one by one on our MT4, we're gonna take every single chart and we're gonna discuss when is best to use resistance and support, where is much easier to identify, also the trend lines. So let's get into it. On the MT4, if you're not familiar with the MT4, you have a couple of buttons here. So for a line chart, I usually press Alt 3 because I am familiar with MT4, but you can just click it here and it will switch to a line chart. On this line chart, as you can see, there is not much to tell. It's just a trend that is moving up, down, up, down. We don't have the price action. This is missing. I suggest using this type of charting when you try to identify resistance and support, because you have the points on the corners, opening, closing. So let me show you how to do it. Also, the time frame is very important. When you want to use line charts, you will always want to go 1 week, 1 day and above, 1 week or monthly. Yeah, so let's take a line and find our resistance. Now the resistance change, we are here right now. Let's go back to 1 day. Yeah, so this is the resistance and the support should be around here. You have a clearer view where the price is moving in between the lines. If you remember the previous webinar, I did show you how to draw resistance and support and understand where are the limits of and market conditions the trend can go. If we're gonna switch to bar charts, okay, you're gonna see something very similar. Now we have the columns, we have the bodies that are formed with opening and closing prices. As you can see, our line it's exactly on the pivots, and here it's almost the same. On top, we can adjust this by clicking on it and dragging it again either up or down. So we are adding a new resistance. It should be right about here. The price did break up. Probably it was a fundamental event. Probably it was interest rates. Since we are AUD, New Zealand dollar, it was most definitely interest rates. If we take the date here, it's 12 August, so most definitely. Now we have a downtrend, as we can see, but to have a better view and understand the importance of candlesticks, you can use this. At the end of the day, it's about preference. If you prefer to use this type of charting technique, by all means do it. But for a clearer view and the correct price action, you always want to use candlesticks. So let's go with candlesticks, and we can see now a lot clearer where it's our support and where it's our resistance with the breakthrough. And if we are switching from 1 week to 1 day, remember that for each period of time, every candlestick represent 1 day, 4 hours, 1 hour, so on and so forth. So if we try to measure on 1 day or even in 4 hours, but in 4 hours maybe we will need to, yeah, in 4 hours we have a bigger picture. In 4 hours, if we try to measure from the top line to the bottom line, it's 283 pips. The price descended since 12th of October, and we are today on 15 November. In almost 1 month, you would have made from this movement alone. Obviously, if you had enough money into your trading account to withstand a potential trend reversal, you would have made trading one lot. You would have made $2,820 if you remember the pip calculation that we had previously. So that's not bad at all. And to be able to predict such movement, obviously you need to master all the techniques. And yes, candlesticks, with candlesticks you can play around and identify descending, trend reversal, and if it were to draw a trend, let's try to identify a trend. Okay, let's take this section for example. If you take this trend line, because it's called trend line, or you can say you can draw with this one, but use just one line and just pull the line on the prices that were up to here. Okay, and you take another one and you put it on top. Now this is what we call an uptrend. For an uptrend to form, you need to have always higher highs, such as this is one example, this is 2, this is 3, and this goes, and highest lows, which means every low should be higher than the previous one. So we have here 1, 2, 3, 4, and we can go on and on. The same can be said for downtrends. So if we go for downtrends, let us clear the chart. So we will take Fibonacci and retrace it since we said March, right? We take the highest point this year to the lowest point this year, and we have ourselves multiple resistance and support. Right about now, you can see you have the 0, which is the bottom one, then you have the 23.6, you have 38.2, 50, 61.8, and the 100%, which is the retracement defined by this red line over here. So if we magnify, we will be able to understand which levels were most traded. Resistance and support, every time you are trading, let's say in between those lines. Okay, we have a trend, a downtrend here. It's very easy to identify. And let's assume that the market will bounce back. What usually happens here, we can trade safely in between those two lines, right? If the price penetrates with the next candlestick our support line, which is 23.6, this support line will become the new resistance and the trend should go up to 0, which will be the next support line. So every time the support is breached will become a new resistance and vice versa. Look what happened here, for example. It was traded safely here. This is the support, this is the resistance. The resistance was penetrated, it went up. Now this line became support and this line became resistance. Now this resistance line was penetrated and again this became support, this became the new resistance, so on and so forth. Usually what happened here, the market is testing the price levels. Sometimes it will just go a little bit over but not fully penetrate, so it may be considered like a false signals for some if you use Fibonacci with double moving averages or let's say RSI or with other indicators. As you can see here, the difference, it's 26.44 pips. Okay, now this obviously could continue as an uptrend, but it didn't. But most of the cases, you just have the testing. What's important is the whole candlestick to be closed above, is not just the shadows. As you can see, we have more shadows than bodies on top of our resistance, and this is how signals are formed. But this is another tool you can use to identify resistance support. Probably in next webinar we will have a deeper look into Bollinger Bands and simple exponential moving averages. Maybe we're gonna use I don't know, 4 moving averages, and on the same chart. I will try to do an experiment with you guys. Let me know in the comments below. I would like to show you the difference between simple moving averages and exponential moving averages to understand the exact impact on how you can read the false signal, and how you sometimes maybe you see a crossing, and you're gonna believe it's a sell signal, but actually it's not. But we're gonna have a better look on the next webinar.
But before we part ways, let's recap what we've learned today. Line charts, bar charts, and candlestick charts. The most common used one is the candlestick charts. You can use the line charts to draw an accurate resistance and support depending on the time frame. Bar charts are meant for price movement, opening prices and close prices if you want a price action analysis. Time frames, obviously, the most important time frames depending on the strategy that you want to build, depending also on the what you want to achieve. If you want a short time period of trades which will pretty much allow you to get in and get out fast depending on the price movement. Long time period of trades which will unlock the full potential of trading, obviously. Devising strategies for months, even quarters. Basics of support and resistance, also using Fibonacci. Trend lines, if we have uptrend lines, downtrend lines, all those we cover in this webinar. Hopefully on the next webinar, which will happen next Thursday, we will have a live trading session regarding cryptos as CFD. We will try to apply some of the charts and the techniques that we've learned today. Keep in mind that cryptos as CFDs are a different asset, and they behave very different from stocks, indexes, and currencies. In another note, for a more explanation regarding charting techniques and the fundamental versus technical analysis, please make sure to subscribe to our website, Eagles Investors, and get access to my first beginner Forex ebook that will help you a lot on understanding how to apply these techniques in certain situation. Now, if you are a beginner, I suggest downloading a demo platform so you can practice. Like I mentioned before, use the demo from UFX, 24 Options, eToro, and last but not least, EverFX. For questions, obviously send me an email and I'll be more than happy to answer all of your questions. I would like in the future to make webinars as interactive as possible. I hate doing webinars where people are just watching webinars for the sake of getting the same information all over again. And what I want to do is have more live trading sessions, and together with you guys, let's build an account. Let's see how fast we can build from X amount of money to X amount of money. We're gonna set together a target. I will put a poll on the website. Every vote matters. We're gonna fund that account and we're gonna start trading live. I would like to have, like I mentioned in the previous webinar, trading sessions where you guys are asking me questions on the spot, because if I'm doing a presentation, I will slightly disregard some of the questions because I want to focus on the presentation and make sure that the information that I relay is understandable. Now, in any case, I hope you learned something today. And like always, I wish you happy trading and every success. Good luck, guys. See you next time.